Leon Binedell, President and Chief Executive Officer at Sherritt International Corporation, YueJer Lee, Director and Co-Fund Manager at Arcane Capital, Allan Restauro, Associate Metals and Mining at BloombergNEF, and Linda Zhang, Battery Materials APAC Lead Base Metals at CRU. All right, so I feel like we've set the tone really well with the two presentations that we've just had. So maybe we can have a quick kind of follow-up introduction. I know our two presenters have already introduced themselves, but Leon and then Allan, if you'd like to introduce yourselves as well, and then we can dive into the questions.
Sure thing. Leon Binedell. I'm the Chief Executive at Sherritt International. We're a principal nickel and cobalt mining company with current production and also some growth opportunities in the space.
Pleasant day to everyone. Allan Restauro. I'm part of the analyst team under BloombergNEF. We are a primary strategic and independent research entity under the larger Bloomberg umbrella. You've seen some of our charts earlier from YueJer's presentation, but yeah, we basically cover everything under the energy transition, and I primarily focus on the role of raw materials on that end.
So, you know, the energy transition is really one of the biggest themes of the metals and mining industry today. So it's really good to kind of be able to talk about what are the key commodities, where is the money going, how is investment being driven, and all of that. So maybe to start things off, where do you see the smart money going? So is it particular commodities that are most of interest, geographies, companies? What do you think kind of are the biggest areas of focus right now? Don't be shy.
I might start as being a company targeting access to capital and looking for investors. What we have seen is, particularly in the North American market, there's been a significant lack of money coming into the resource sector and the processing sector, which has sort of precipitated some of the graphs you've seen earlier today, where there's a significant lag in processing capacity being built out or actually mine development. And part of that is regulatory driven as well. And so as a company in that space, we think we're well positioned to take advantage of metal price increases from that. But we still haven't really seen significant dollars come into that space yet.
Maybe I can just add a little bit. I think in general, we've seen a slowing pace of the investment across this industry. And in my presentation, I've mentioned about there's a lot of risk. So first of is profitabilities. And the second is just in general, there is a lot of regional protectionism on the rise. And even the most clearly structured IRA, it is not that easy to navigate. And particularly when you're looking at that, there's very stringent rules and also a kind of like vague definition of the FEOC. In essence, that the US regulators also preserve the right that they can assess the individual operations on a case-by-case basis. So that really gives a lot of anxieties for, say, some of the battery manufacturers that we speak to, that they wanted to invest in mineral resources and also secure the supply. But at the same time, they are uncertain whether, even if they make this investment, whether first of all, it will be compliant, and even they are compliant and how cost effective they are. So yeah, just general in the industry, there's a lot of uncertainties that are holding people back.
And if I may add, I guess, for one, I do agree with the sentiment that this investment doesn't necessarily flow into the resources side, basically anything upstream. I think similar with Linda, I mean, for us who look at this industry from a very high level, we don't have a ball in the game. It's not like we want for nickel to be the dominant player and not want LFP to rise, something like that. So what we see in the data is one, in terms of, I guess, where the money is going. In terms of energy transition investment, BloombergNEF has been tracking this for quite some time. Electric vehicles and basically the transport sector has overtaken the power sector, anything from renewables in terms of total investment last year. And that will likely increase because of what you've seen today. But in terms of where that's going within that certain sector, a lot of that is on the downstream side. The overcapacity in the industry is really on the battery manufacturing side. there is still a lot of overcapacity, even in China, to meet the global demand a few years from now. So that speaks volumes on where that money has gone and where likely it's going. A lot of the players looking at the energy transition are basically new to the mining industry. They're not really long-term mining players. That's why when prices crash, it's very difficult to sort of see their investment play long-term. So a lot of them have scaled down their plans. So yes, smart money is going into the energy transition. It's going into where it needs to be, I guess, in terms of overall industry. But if you break it down further into the value chain, it doesn't necessarily go to the raw material side, which is essential to actually supply the needs of basically the feedstock to that manufacturing capacity.
Yep, I think Alan's right. We are still seeing a lot of money go into nearer the consumer part of the supply chain. The car manufacturers, they're still managing to raise money. But upstream at the mines, well, apart from silver companies, which I think are still doing okay in terms of fundraising, none of the other battery minerals companies are actually able to raise money easily. I can tell you where the money is not going. They are not going into lithium. They are not going into, not enough is going into nickel, not much is going into cobalt and graphite.
And so how do we focus this funding into the upstream? Is it through government initiatives? What would you suggest?
I might get us going again. What we've seen, I think, to the earlier comment as to where the money has been going, has been tied to incentives to a large degree. And a lot of the government incentives have been downstream in the consumer-facing side of things, in the electric vehicle manufacturing, for example, and some of the battery manufacturing, and particularly in North America, a lot of that focus has been around that domain. And so what we believe is likely to happen and sort of indicative by governments is that they are shifting some of their support into the further upstream markets, into minerals processing and ultimately raw materials mining. And so we're seeing a lot of that government incentive drifting that way, but we're also seeing the regulatory hurdles being addressed. And so in Europe, they're putting specific timelines down on critical minerals. Canada is attempting to do that in a sort of lopsided way. The US is funding through Department of Defense to try and accelerate mineral development. So very much tied to government incentive, both from a financial perspective, but also regulatory.
And I agree with Leon. I think this government subsidy was instrumental to cultivate and also subsidize at this crucial price, low price environment. But I think it's quite interesting if you're looking at some of the more advanced economies, like in Canada, in US, in Australia more often, if you're looking at their subsidies, they are start to focus on the refinery part. But then the midstream, the cathode pcam, still kind of neglected. And if you're looking at the Southeast Asia, for example, most of the governments still very much focus on localizing the electric vehicles or EV consumption, but with little effort for the upstream. So I would say that that there is start to focus for the refining process, but then the incentive is also not particularly strong. If you're looking at the capex intensity, for example, to build a refinery, say lithium hydroxide in China versus in the West, it is not just 2 times, it's more than that. But like 48C, for example, in the US, or the critical mineral incentive in Australia, that provides around up to 30% of the subsidy. And that is not sufficient. It's like a drop of water in the ocean, so we definitely need more substantial incentive from the government in order to incentivize this industry to thrive.
But I don't think it's a matter of just money. I don't think money can solve the problems that we are looking at right now. What's happening is that, yes, you can fund a new processing plant, for example, but look at what's happening with Albemarle's Kemerton project, right? They can build it, they can put the equipment in place, but they cannot ramp it up. The skills are not there. So what I think really needs to happen is for these skills to be brought out of China. However, they want to incentivize it. Being less anti-China would help, but so far that's not happening.
Yeah,
I think just to sort of add, bringing that outside of China, I guess it also speaks to how the export story is shaping up. I mean, as mentioned, protectionism is key in the discussions right now, which is unfortunate because the energy transition is a global story. There's not one country that will be able to sustain their needs or sustain the world's needs. And Linda showed earlier the chart for comparing domestic production of an NMC 811 versus if they would import and add the tariffs and critical minerals duties. If you look at an LFP, it's actually negligible. Like it would still be easier for a Western producer to just import LFP and have a more competitive car than producing LFP locally just because of the cost difference. And that's where the skills comes in because China has been able to really leverage their method of scaling up their own production side. So that's why cost is really low in China. The cost of an LFP is lower than the cost of lithium carbonate. Think of that. Like the raw material that goes in is cheaper than the final product just because of the competition. So they have nowhere else to look to but outside. But I think the world, unfortunately, is shutting that down because of this protectionism narrative. But the other thing really is on the policy side to drive investment here. It can also go both ways. I mean, Indonesia has been successful there in their nickel story. But essentially, that has also brought other producers down. And apart from governments dictating the policy, I mean, Australian producers have been begging the LME for a green nickel premium, but the LME said that it's not currently mature enough to have a market of its own, and that led to where we are now. So I think it's not just the government's policy directive, but also the major players in the industry, such as the LME, dictating the price that needs to adjust to the overall structure of metals for the energy transition, especially I guess for nickel, which is a very peculiar case because a lot of the overcapacities in class 2 nickel, not suitable for batteries, but overall they're still dictating where prices are headed.
Do we have any questions from the audience before we continue on? Happy to make this a little bit more conversational.
YueJer, you mentioned that smart money's not going to nickel and lithium. Then where is it going? Apart from silver, which we know. Is it going anywhere? I mean,
Not really within the mining space. What's happening is that smart money is going into tech, into AI, into everywhere but mining.
Yeah, that's correct. I think smart money, well, I don't know if it was smart because they probably lost their money, but was going into.
Yeah, let's not use the word smart.
But it's all, thing is with commodities, it's very cyclical. So nickel and lithium are down at the moment, but you know that in a year's time, 6 months' time, or 3 years' time, you're going to hit a higher again, right? So, and then financing will come in. It's sort of like that's the case.
Yeah, but that's low prices will cure the current low prices, right? Yep.
But also, if I may add there, mining is a cyclical boom and bust cycle. We know that, but a lot of people who entered recently probably didn't really realize that. But also, in terms of that smart money, in terms of its behavior, I mean, all the major mining companies, for those who have been tracking their capital costs, it peaked in 2016 and never really recovered. And that's for all of the mining industry. Right now, gold is surging. I'm not sure if that will bring that much hype again to make that recover to where it needs to be. But that's the challenge, right? Even with some periods of high prices for battery metals, it hasn't really pushed that investment side overall in the industry up. So I think that's something that needs to change as well within the industry, which again, based on our conversations, is very challenging.
Also add a bit, like there is an increasing push for vertical integration. So within the industry, there is a lot of investment sentiment from the OEMs to secure the raw materials. So that's already happening. So they use stances such as they invest in equity ownership or like either long-term supply chain agreement. So in a way that they both secure the supply and also they can lock in prices in some cases, depend on how they negotiate the term. But I guess just within the industry, there's already kind of like very strong push for the integration, and that's within that cycle for the investment.
I just think on that integration point where OEMs have been struggling somewhat is net new facilities, new mines, and the permitting risk and the timelines around those. it is fairly new for the downstream consumer of the product, at least the growth sector in the energy transition, in understanding how the whole supply chain works. And there's going to have to be greater collaboration with players in different parts of the industry, and the collapse of the value chain, of having less players in the value chain as opposed to a miner, a refiner, a downstream processor, and a battery maker. I think there's going to have to be some overlap across the different parts of the value chain. But from the raw materials perspective, and those that mine and produce raw materials, in the absence of real, robust, long-term support from offtake arrangements, no one's going to make an intermediate product. The only countries we've seen where this happens is in China, where the capacity is being built out for their own strategic purposes. But in a sort of Western context, unless there is economic sense and security of arrangements, no one's going to build these intermediate product arrangements. And so you find, if you want to build an LME product like we do, there's maybe some money for that because there's a terminal market. But if you're trying to make an intermediate product, the first question is, where's your long-term offtake? Where's the product coming from? And unless you have all those arrangements secured, there's no money coming into it.
Yeah, I think Linda actually hit upon a point that's quite important. If you talk about smart money coming into the industry, what has happened in the lithium space, which has actually never happened in other industries, is the end user coming in to own the mine. So basically, we have examples like GM coming in to own the Thacker Pass mine. Plenty of other examples where end users have gone in, not maybe, if not the equity ownership, at least direct offtake with those mines. That has, to my knowledge, happened only within the lithium industry. In no other metal industry has this happened.
I just also want to illustrate your earlier points that it's not just about money, it's also about the technical know-how. So that processing and midstream chemical production phase is being neglected because it was traditionally just has much smaller margins. So the Western producer are not always interested into extending from upstream to the midstream. And now, when China has spent decades to fine-tune and also make it very, very cost-effective, and to build something from scratch in such a short frame, it is really challenging. And even for the Chinese producers, they saw the opportunities and they are willing to offer the technical support. But such collaboration would risk classify the whole project as FEOC, because the general direction from the US is to decouple from China to minimize the Chinese participation. So it's really a shame, because if that's not the case, then there is a collaboration, globalization. So leveraging what the technical advancement from China and integrate and help the West to build some of the missing part of the value chain.
I hear that China is more cost-effective to produce, and I've heard that money is not going enough money is not going into the industry. Okay, but these days the investor are having the consideration, okay, from the perspective of social and not only economic but social and environmental aspect. Okay, whether is it responsible? Okay, is that enough being done actually to improve on these two aspects of being social and environmental responsibility?
I think certainly from what we've observed in terms of some of the government behaviors has been less supportive for players that don't meet the same standards. I know Canada's sort of a leader in some mining standards and some environmental practices in very much in the upstream industry, and exporting that capability and expectation. And in the absence of globalizing some of those, we do have a uneven playing field and I think this is where the Australian industry really complained and were looking for a green nickel premium in particularly, is the cost base is fundamentally different if you're producing things in a certain way versus maybe to lesser standards. And then how do you compete in a globalized environment? And so that's where I think some of the aspects of how the industry is also played out in terms of the cost base of different parts of the value chain, particularly the way the Chinese have approached things, has been helpful in their cost base. certainly following the same standards will increase their costs, and we're starting to already see some of that play into their cost base. But just to make a comment on the sort of east versus west, I think there's a natural behavior by countries to de-risk supply chains. I think COVID had really highlighted some of the risks in supply chains being single source of failure, single countries that have access to things when vessels get locked up outside of China, ports are locked down, nothing's moving anywhere in the world, and the implications of that. And so some of it is quite negatively perceived as being the US being anti-China. I think it is not entirely unrealistic to expect to de-risk supply chains to have more of a balanced scope of supply across the globe. We were facing climate change and wild weather and wildfires all over the globe. If we're tied to a single source of Indonesia and cyclones or typhoons and things come through, it will have material implications on supply chains. And so having a global balanced source of minerals, source of processing makes sense for the globe ultimately. And the demand is so high. I mean, I think some of the graphs we've seen, it's quite exponential, and we have to build more capacity. There are pockets of expertise in the West. Our company has got technical expertise in hydrometallurgical processing. For nickel and cobalt particularly, we can make that, but it is not persistent across the entire value chain, across the metal space, and so we are more dependent on importing some of that skill set from other parts of the world.
I think I can offer a case study. Well, not necessarily a case study, but in my experience, having talked to key stakeholders within Indonesia itself, it really is a challenge in terms of ESG. So I think Indonesia is towing the line between being friendly to both China and the US, simply because they don't see this as supposedly an issue. Because one, they have the nickel. It's just a matter of who wants it. That's sort of the perspective from Indonesia. Based on my conversations, they did say that it is more difficult to converse with Western producers compared with China-based producers. Simply because one, China is willing to supply the technology based on their own sort of plans. But for the West, there are a lot of other indicators that must be met that Indonesia is sort of leading to a comparison between the two. Now, it doesn't necessarily mean that China is not thinking of ESG. I mean, at the end of the day, any mining project will think of ESG, especially within Indonesia. So I guess that sort of puts context on how that reality is within these major producers. The other thing is the concept of, I guess, large-scale producers who have the capital to actually mitigate, address risks in terms of ESG versus smaller players, which might not necessarily follow the same standards that at least for the large-scale producers, they think that these producers are bringing the image of mining down further. Because one, mining is already at very challenging optics in terms of ESG to the general public, I would say. That's why it's getting harder, I guess, to get support on the I guess ESG side from just the optics of it. Of course, at the end of the day, discussions are based on the data, the analysis, and as mentioned earlier, the standards that these companies comply with. And Indonesia has been bringing more of that standardization. I was at the Indonesia International Sustainability Forum last month, earlier this month rather, and there were representatives from the International Council of Metals and Mining. The Indonesia Mining Association mentioned that they will have an audit for the standards for IMRA, or International Mining for Responsible IRMA rather, International Responsible Mining Association. So these standards help so that investors can vet the projects themselves. But overall, the other challenge is what really is responsible mining. It's not clearly defined. One definition might not be a standard for everyone. So these standards help sort of navigate those difficulties and arrive at that. responsible mining standard that someone can look at. And yeah, Indonesia, even though they are partnering with some other entities, not the West, doesn't mean that they're not responsible in terms of their activities.
I would like to just add on a little bit to 2 points. First of all, I think the Chinese producers, whether they invest overseas or domestically, they're certainly getting more conscious of these, like the ESG regulation, and particularly when they're dealing with, say, the European OEMs, they really need to trace where they source the material from, to the extent of indicating which that batch of metal coming from which furnace, say from Indonesia. So it's really tracing back. And also some of them have indicated that they have been requested to include a certain proportion of secondary sources. And that threshold is increasing. So that environmental responsibility is felt by the entire value chain, for sure. And the second point that I would like to make is that it's, again, coming back to the missing part of the chemical processing in midstream. In Europe, what we have seen is that there is a sudden pullback of a pecan plant in Finland. And when we look into what is happening, given that announcement has been made several years ago, and the reason being that to have an environmental license, the government issue it, and then there will be 1 month of public feedback. But then they face a lot of backlash from the communities. And as a result, it has been annulled several times. So making the pecan processing quite difficult to localize in the region, because inevitably, the chemical processing will produce certain level of impact to the environment. So that's one thing that, to localize supply chain. But if you have zero tolerance for any sort of emission and discharge, then this is unfortunately the dilemma.
With regards to your earlier presentation on solar panels, what sort of returns do you think these solar panels are getting? I mean, assuming the sort of lithium prices that we have, because you are assuming that there's going to be a lot of absorption of material going into batteries going into batteries. So what sort of returns do you think these battery storage companies are making to justify large investments? What sort of hurdle rates do they have?
Wow, this is I'm afraid there's no easy answer to this question, because a lot of this depends on the individual countries and how they deal with power dispatch and sale agreements between each producer and the grid and the energy authority of the country. So this is not something that has an easy answer, but let's tackle it from another point of view. Batteries, nowadays, grid batteries are being produced with LFP, right? LFP has a cycle life, charge-discharge, of about 15,000 cycles today. Okay, so if that battery charges and discharges once a day, it can effectively last 40 years. So take the current price, divide by 40 years, divide by it's how much it can store, basically dispatch, and we can roughly work out the math. It's a couple of cents per kilowatt hour at that cost, at that capex cost. With electricity prices at potentially at the wholesale maybe about 15 cents, there's a very, very large gap there. And how much of it is actually captured by who then depends on the contracts.
So why are governments not, because there's a lot of waste, as you see, the duct, right? So there's a lot of energy that's thrown out. So why are governments not accelerating these projects? I don't see many mega, gigawatt battery installations globally.
Yeah, there's actually a phenomenon called curtailment that's happening. So if too much power is being produced, it's literally grounded and wasted. So I think it's not up to the governments to say, okay, you guys all have to install battery storage. The market will do this for them. As if the power producers are losing potential revenue or selling at a low price during the weak hours, well, actually no, mostly they have fixed power price offtake prices, but that's besides the point. Okay, then they themselves will be incentivized to store, to build batteries and be able to dispatch it at the end of the day when they can then put it in the contract that says, oh, we get the end of day pricing.
All right, so just to wrap it up, let's have some closing thoughts from our panelists. Maybe on the way forward with this, navigating regionalization, a lack of investment into the raw materials. What do you kind of propose for the way forward?
Certainly, from our perspective, a lot of the government policies and the recognition of some of the challenges in the upstream is helpful, particularly as some of the government incentives are moving in that direction. I think standardizing certain expectations around battery passports, carbon footprint dynamics, some of those things are flowing and starting to become globalized standards is helpful to determine more of a global playing field for investment dollars. I think the de-risking of supply chains is going to drive people's mindset around where investment dollars should be going. And I think we're going to start seeing a shift in that, particularly when metal prices start picking up. I think we've moved into a domain of generalist investors, so they don't understand the industry as well, as you mentioned. But there's a lot of education going on. And so we do see this as sort of a matter of time before dollars will be flowing. And then for us, we're trying to position ourselves well for that because we think that is coming into the West as well.
If I can use a forward-looking stance and using one word, I'm really excited about the innovation that also come in space. That what we have perceived about, say, the market share of the cathode chemistry 3 years ago will be completely different. It's different now, and it's definitely going to be drastically change, 5 year onwards. So as I mentioned about the pressing need to find a sweet spot that providing the best cost-performing ratio for the battery manufacturers, and there will be increasing competing technologies that comes online. And yeah, like we have been closely traced. So previously, the NMC was perceived as more of the promising stream, but more recent, what we have observed that LFP is not only maintaining market share, but also increased it in China and elsewhere. So it is really interesting to continue tracing this dynamic, and it's hard to predict, to be honest, at this point of time. But I do look forward to see what is come.
And I guess I'll pick up on that with saying that one, long-term demand is certain from what we've seen now, what the industry has been saying, what the analysis is showing. There's no changing the trajectory of the energy transition. But along that path to growth will be headwinds, uncertainties. This growth is not linear. I guess in the case of EVs, for example, we expect them to grow at 19% year on year this year, much lower than before. But same as what I've heard from a previous conference I attended, this guy said, if 19% is a bad year, which is what a lot of people in the industry are sort of saying as a sentiment, he would like to see it on a good year. And that good year is coming. And that is certainly why the industry needs to position itself in order to take advantage of the long-term growth in terms of demand for raw materials, in terms of the surge in the energy transition. And I think what we've shown so far, at least seen so far, is just on the techno-economic modeling side. We're not even talking about if we have that path that we need to reach net zero. And that will accelerate demand for raw materials more. So again, long-term demand is certain, and the industry just needs to position themselves to manage the risks along that path to growth.
Yeah, on this whole decoupling thing, I would like to perhaps go out on a limb slightly and say that it might be doomed to fail. So what we are seeing is this whole trend of wanting to secure your own supply chains, decoupling from China, is basically government action trying to fight market economics. And what we know is that in the long run, the economics always win. So perhaps this decoupling thing results in a two-tier world where the countries that want to decouple from China are willing to or happy to absorb a higher cost of everything. And those that are happy to work with China have a lower cost of everything. And to the extent that this affects the way we think about investments, then I would still say go for the projects with the lowest cost, the best economics, and those should do well in any environment. And that's how I think most smart money would think about this whole theme. Do you want to base your investment thesis on potentially shifting government policies? And even government policies are not set in stone. They change. The next government comes and repeals things. Or EU tariffs. The EU wants to put tariffs on Chinese cars, right? But we are already seeing a country like Norway pushing back and saying, no, you guys can set your own tariffs, but we don't want to impose those tariffs. We want cheaper cars for our people. And that's what's happening. That's the pushback already at this very early stage of decoupling. So just let me say, I don't think this decoupling thing will actually happen.
We'll see you then.